Beef Market Update with Ann Dunford on RealAgriculture.com is brought to you by Haney Farms. Do you need seed? Find us at HaneyFarms.com. So, Ann, a lot of discussion about the U.S. drought. Horrific looking corn crop. What kind of impact do you expect that's going to have on, right now, the U.S. market from a cattle perspective?
Well, first of all, I mean, the impact is already being felt. I mean, we've had huge, of course, move up in the grains, and of course, as that's happened, we've had the corresponding move down in feeder cattle prices on the futures market, and now the cash cattle in the U.S. as well. So the immediate impacts, it's happening as we speak. As the costs go up, it's got to come out of somewhere, and it comes out of feeder cattle, as it always does. So the thing is, it was such a surprise for how widespread and how devastating it is, especially when we had such big acres going in to start off the year. So kind of everybody went into the year thinking, okay, we're going to be expecting this kind of a crop, this kind of cost, and started to trade feeder cattle accordingly.
We were talking $4 corn.
Yeah,
possibly.
or sub 5 at least.
Yeah.
And now, of course, the situation is $8 and where to from here. So all of a sudden, all those game plans go out the window as far as what you were expecting costs to be, and therefore what you're able to buy feeder cattle for.
There's been a lot of focus on the corn yield from a grain perspective, but I have been reading that some people speculate we're going to have one of the worst forage supplies in since the 30s. So obviously access to cattle feed being silage is going to be a big problem this year too.
Silage, hay. I mean, last year we heard lots of stories. We've talked about drought in the U.S. for 2 years now, but this drought is different. Last year was very much centered in the deep south, Texas, Oklahoma, cattle country, and that's why we saw the big movement of cows to slaughter. Lots of calves went on feed early last year, those kinds of things. This drought, of course, much more widespread. It's moved north into the central U.S., and now, of course, you're impacting key crop producing areas. So you've got that impact going on, and going forward from here, it's just that much broader. You have impacts, like you say, to forage, to hay, and what happens to the cow herd now. Now, so far, we haven't seen the big cow slaughter sell-off yet, but I think as time marches on here, that's definitely still up for debate.
Like we really need to reduce the cow herd anymore.
Well, we're in a position like we talked last year where from a price perspective, the market should have been starting to see some expansion in the U.S. cow herd, and now we saw the summer report, down another 3% on beef cows, down another 2% on calf crop for this year. This is going to most certainly set the number lower to start off 2013, and that's not what the original analysts were expecting to start off next year in the U.S.
So how does this affect the Canadian market story?
Well, again, prices, and we talk about this all the time. Canadian cattle price is derived from the U.S. market, so absolutely it has an impact. Basis spreads are probably the biggest differential, and we'll see some wild action there. But this is going to set the stage. It is setting the stage for lower feeder cattle prices. It's the middle of July or end of July. There's not a lot of cattle moving right now. Conditions up here are superb. But when it comes to price, it's not going to matter much.
So when we talk lower, what kind of pullback can we expect?
Well, let's look at what's happened to the futures market. Now, granted, you can say, well, it got too high in the first place and maybe it's gotten too low now, but the futures market on feeder cattle in the U.S. and Chicago went from 160 plus to 134. So you've taken close to $25 a hundred out of the feeder cattle market, and that's a big chunk in 4 to 5 weeks that it's happened. A very short period of time it's been removed. So
for a Canadian feed yard, though, expecting to buy cheap feeder cattle this fall, that maybe would be going too far as a statement?
Well, again, we've got a situation up here where we've got the supply of forage. Grains have moved higher. Our cattle on feed report is showing inventories well down to start off July 1, and it looks like that's going to be the case as we continue to go through the rest of 2012. The inventory just isn't there to place on feed, so we've got this. Cattle feeders are losing quite a bit of money. Costs continue to go higher, and yet pens are empty. And so it'll be interesting to see how things sort out as we go through the rest of into the fall, into the grass run first of all, and then the calf run. But they'll be lower. The question is how much lower when you've got a demand side still likely to kick in.
Feeder cattle exports could be, or they're looking to be strong this year.
Well, I think that's changed too, Shaun. And 2 months ago, I would have said, well, we were running double the pace of 2011. and it looked like lots of feeder cattle were going to move into what we thought was going to be potentially a cheaper cost to gain area in the U.S., and that's completely changed. It's done a 180. So feeder cattle that were intended to go south aren't. They're not going to move south at $8 corn. And the flip side, if we've got the forage up here, could you ask the question, do light calves move up for this cheap forage? And again, I'm posing the question. It's freight's an issue and all those kinds of things.
Canadian dollar would have a say in that.
Sorry?
The Canadian dollar would have a say.
And the Canadian dollar plays a part, obviously, in what direction. But don't rule that out. Or we saw hay move south last year. You're going to see hay move out of Western Canada into the U.S. Especially we're going into a closer area now in the Nebraska, Wyoming areas, Colorado. You can move hay into those areas.
How do you feel about the fat cattle market in the fall? We had talked at one time about we would see the spring highs, the summer lows, and the fall highs again.
Yeah.
How do you feel about that?
Well, we're on track. I mean, we're traded last week at 113, which is bang on the 13% drop from our spring high. So that everything as far as what the U.S. market has done so far is what we were anticipating. Now going forward into the latter part of this year, we are, I think, going slowly forward from here. The market is going to start to potentially grind higher. We've got supplies that are still going to be tighter overall. We've had a disappointing or not as strong an export market situation as what we were originally anticipating. So I do think we'll take some of the spark off of that fall high, but demand plays a big part. So you got supply on one side, you got the demand story on the other side. And demand seasonally improves as we get out of the heat of the summer, especially this year. It's been the heat of the summer. So I think today you're seeing the worst of the worst from a demand perspective. And I'm going to still stick to the point that maybe we don't run back and take out the spring highs, but I'm going to suggest that we'll get back to some levels that are nearing those.
It's looking like Cattle Facts was maybe correct at NCBA about they talk about a large volatile year, over $300 a head in value swinging back and forth. And that's kind of playing out.
Yeah, and I don't think anybody really saw exactly what's happening today, but the volatility forecast it's looking like that's getting to be a pretty simple forecast. Whether you're talking about grains, whether you're talking about exchange rates, cattle, you name it, we've got a crazy volatile marketplace, and that's the reason I think you're seeing more focus on risk management, just more all the time, and I can't accentuate that anymore.
Okay, Anne, thanks a lot. We'll talk to you again soon.
Okay, good.